With Home Depot about to report earnings, is it a good stock to buy right now? Welcome to Global Value. Today, we're performing a fundamental analysis of Home Depot using Warren Buffett's investing framework. We'll look at 6 key financial metrics before we figure out 3 different fair values to understand what Home Depot is worth in today's stock market. Plus, I'll share 2 special bonuses that could be the deciding safety factors when adding Home Depot stock to your portfolio. Right now, Home Depot trades for $348.64 per share. In its last day of trading, it's up 0.09%. From August of 2023, Home Depot stock is up 5.7%. This is behind the market, with the S&P 500 up 15% at the same time. In the last 5 years, things have been pretty close, with the Home Depot compounding at 9.1% annually. In the last decade, they've done even better. They've compounded at 14.6% annually, and they beat the market over this entire time. Since before the global financial crisis, Home Depot has compounded at 12.2% annually in the last 19 years. Right now, they pay a market-beating 2.45% dividend yield that's added onto these gains, and Home Depot's grown this for 14 years in a row. Today, Home Depot trades $70 above its 52-week low and $40 below its 52-week high. And how big is the business? Today, they have a $345 billion market cap. Getting started with our first metric, we want the Home Depot's average returns on capital to be greater than 14%. Think of this like your form when you're lifting weights. You want great form just like a company wants great value. Over the long run, it's these returns that can drive gains in stock price. Worth noting though, their returns have been dropping since their high of 50% in 2022. Still, when they're averaged out, the Home Depot earns 44% returns on capital in an average year over this time. That's more than 6 times better than a normal business, and this is a huge check on our first metric. Things look good for Home Depot so far. Now, what does the company really do? Home Depot is the world's largest home improvement specialty retailer. It operates more than 2,300 warehouse format stores, offering more than 30,000 products in-store and 1 million products online across North America. Its stores offer building materials, home improvement products, lawn and garden products, and decor products, as well as various services, which include home improvement installation services and tool and equipment rentals. The acquisition of Interline Brands in 2015 allowed Home Depot to enter the MRO business, which has been expanded through the tie-up with HD Supply in 2020. The additions of the company store brought textiles to the lineup, and Ready Carpet added multifamily flooring. The most recent acquisition with SRS helps grow professional demand. Next, we want sales, earnings, and free cash flow growth to support their high returns. In the last 5 years, Home Depot's grown their sales by 38% up until today. Their earnings are up by 32%, and the company's cash flows have led the way, most importantly, growing by 62%. This is great growth across the board for the business, and it's another strong check on our second metric. Now, who owns the business? Today, 7 super investors own Home Depot, and this is led by Tom Gaynor from Markel Group. He has a 3% position in the business. Next, we want to look at Home Depot like an individual shareholder. In metric number 3, we want earnings per share growth. Over this time, Home Depot has very steadily grown their earnings per share. They've increased these from $10.25 in 2020 to $15.11 in 2024. Not only has the company's earnings grown by 32% over this time, Home Depot has also bought back 10% of their shares. With low store growth, the company's returning a lot of capital to shareholders. This can be a great thing, assuming they were done for below intrinsic value. Either way, it's a check on our third metric. Next, we want free cash flow growth. In metric number 4, this is similar but even more important. Home Depot's free cash flows have led their growth charge, increasing by 62% over this time. In their last 12 months, Home Depot's brought in $18 of free cash flow for each share they've had outstanding. That's great growth, especially considering free cash flows are the lifeblood of any business. It's another check on metric number 4, and Home Depot is a perfect 4 for 4 so far. Now, why don't we check out their dividend? Today, Home Depot pays a big market-beating 2.45% dividend yield. But the question is it safe and can it keep growing? This is why we want their dividends to be covered by their cash flows. Home Depot has done a great job of this today and in the last 5 years. They easily support this, and they maintain a reasonable dividend payout ratio. Home Depot grew their dividends by 8.77% last year. This, coupled with their buybacks, means they have a nearly 5% yield to shareholders today. This support for their dividends is exactly what we wanted, and it's a check on our first bonus. Next, let's look at their balance sheet. Home Depot's a great business because it earns high returns, grows, and it doesn't need a lot of debt. In our fifth metric, we want their net debt to be supported by their free cash flows. Home Depot's grown their net debt over this time and started 2024 with $49 billion worth. Today, this sits at $47.7 billion, yet in the past 5 years, when we add up their cash flows, Home Depot's brought in $71 billion worth of that. This is easily enough to support their debt loads, and they could pay off all of their debt with just 3 years of free cash flow. Home Depot brings in a ton of cash flows, and this looks great long-term for the business. It's another solid check here. Does Home Depot have what it takes to be a perfect Select 6 stock? We'll find out after we cover our safety bonus. Warren Buffett's teacher and the father of value investing, Ben Graham, wanted to see a current ratio of greater than 1.5 times. This guideline is a key safety ratio when you're picking stocks. Unfortunately for Home Depot, they've been below this in all 5 of the last years. Fortunately though, they've been above 1 times. Still, this may not be something to lose sleep over. The company has strong market power, and because of that, it can have different working capital requirements than other businesses. As a retailer at scale, they can be at leading terms with their suppliers and vendors. This causes some businesses to have negative working capital, as is the case with Walmart, Apple, and Amazon. That's something to look at more, but this is still an X. But don't let that discourage you. Now, what is Home Depot worth? The big metric of them all, metric number 6, is our first valuation. We want Home Depot's average cash flows divided by their enterprise value to give us a yield greater than 5%. This would match the historical yield from the S&P 500 and beat the 10-year Treasury. Today, Home Depot has a $393 billion enterprise value. That's what we get when we add their market cap and their net debt together to look at the company more like a private business. In an average year over this time, they bring in $14.2 billion of free cash flow. When those are divided by their enterprise value, it only gives us a 3.6% average free cash flow yield. In the last 3 years, they bring in around a 4% yield, and in their last 12 months, they brought in $17.9 billion worth of free cash flow. That gives us a 4.6% current yield. All 3 of these are below that 5% benchmark we wanted, which means this is an X on metric number 6 for Home Depot. But don't throw the business out. We still have 2 more valuations before we reveal their fair value. Next, we'll use a DCF model to credit Home Depot for its growth. They've been a very predictable business. This means we can take their cash flows and use historical assumptions for their growth. Still, it's up to you to check these. Let's assume Home Depot grows their cash flows at 14% annually for the next decade. Then in the following decade, we'll assume this growth rate is cut in half and they only grow at 7%. We'll look for a market-beating 15% rate of return, which is what Warren Buffett wants from his investments. Based on those assumptions and today's multiples, this DCF valuation says their fair values are around $284 per share. Throughout its history, the Home Depot has been a long-term compounder and one of the top performers since the global financial crisis. Keep in mind, Home Depot trades slightly higher than where they have in the past decade. Based on their multiples and analyst estimates for the future, our third fair value comes in at $333 per share. Now, Warren Buffett likes the numbers, but it's a company's qualities that are his true love. Why don't we learn what these are for Home Depot through a long and a short thesis? We'll start with a long thesis first. Number 1, Home Depot's continued investments in supply chain and merchandising should improve productivity and support its market leadership position in the home improvement market. Number 2, the Home Depot has returned $73 billion to its shareholders through dividends and share buybacks over the past 5 years alone. That's nearly 20% of its market cap. Home Depot should continue returning capital to shareholders over the next 5 years and beyond, possibly as much as $80 billion in that time. And number 3, the addressable MRO market is around $100 billion. Interline and HD Supply make up a low double-digit share, leaving meaningful upside for grabs. In March of 2022, Home Depot made an $18 billion acquisition for SRS Distribution. They're a trade distributor serving multiple markets for Home Depot's pro customers. But things aren't all positives. Let's look at a short thesis as well. Number 1, weak consumer spending, higher interest rates, and an economic downturn could hinder sales for home improvement projects. This would affect Home Depot's growth. Number 2, IT and supply chain improvement gains could prove more challenging to achieve. Simpler efforts have already bore fruit. Further productivity efforts could face some implementation risks, which would create inconsistent profitability. And number 3, as home improvement demand continues to normalize, consumers should continue to shift discretionary spending away from home improvements and back into other discretionary categories. Now let's put everything together for Home Depot. In our fundamental review, we learned the company goes 5 for 6 on the Select 6 analysis. They earned great returns, they've grown in the last 5 years, and they've seen a boost from the pandemic. The company also returns a ton of capital to shareholders through both share buybacks and a strong and growing dividend. On top of this, Home Depot uses a reasonable and modest amount of debt in their business, and they generate a ton of free cash flow to cover this. There are still growth opportunities for the company ahead, and they've made some major acquisitions to support these. Still, in the future, they may not see the same gains that they've seen in the past. This could come from a number of headwinds, including increased competition and changing consumer behavior. Remember, this isn't financial advice. When we put Home Depot's numbers and qualities together to estimate what they're worth, today a Home Depot fair value looks to be around $312 per share. That's down $36 from their current stock price, which means Home Depot looks slightly overvalued. To find undervalued stocks, sign up for our investing tools in the description and get exclusive bonus coverage of 109 stocks and counting.